All right, welcome to the second episode in this continuation of lessons learned so far in 2022. Just to recap, 2022, it's been a tough year for everybody, investors and non-investors. There's headwinds everywhere, like I've been saying. Lingering effects of COVID-19, rising interest rates, rising inflation, Russia-Ukraine war, stock and bond market falling, commodity prices rising. And the economy, as I call it, is just kind of coming off a hangover. So it's been a lot to deal with. And in these episodes, trying to relate these things or conceptualize these things to us everyday people. There's a lot of variables going on out there. So I want to pick three things that we can observe from 2022 so far in certain categories. And today I want to talk about people that are mid-career. What have we learned so far if you're a mid-career individual? What are some observations and what can we learn from them here? So let's get into them. So the first observation I've noticed for mid-career individuals is you need to have a backup plan. The observation here, a big thing I've seen so far is that people in this category, they have not planned enough for the what ifs or the oh craps in life. Now, this is financial planning, high level financial planning. I'm talking about emergency savings, emergency funds, backup. We've all seen extreme inflation this year. And in some cases, I've seen some families or couples have a layoff. And when you get this 1-2 punch, it's very hurtful for a household. So mid-career individuals or families need to understand they have a lot of responsibilities at this age. They have kids, they have mortgages, sometimes even helping out aging parents or siblings. They have a lot going on. So the main observation here I've seen is that what people thought was a good amount in emergency savings or backup plans just hasn't been enough. So what do you do? What can we learn from this? So let's just go back to some of the basics in financial planning. Traditional financial planning, if you put your financial planning hat on, I sometimes say you need to have at least 6 months of wages in emergency savings. So if you ever talk to me, though, I'm always saying cash is king. So I'm always even more conservative on that end and think you need to have more than just 6 months in emergency savings, literally drive up money that you can go to the bank, go to the ATM and get. Okay, to take this even a step further, I think you need to have backups on backups in your financial planning. For example, let's say worst case scenario, you run through these emergency savings, this 6 months, quote unquote, emergency savings that traditional financial planners will tell you to do. Well, you've ran through that. What do you do? Where do you go next? So a backup plan upon a backup plan. What's your backup plan? And here's what they can be. Well, Roth IRA contributions can be a source of tax-free, penalty-free money if need be, if you've met some requirements. If you have HSA money, you can essentially pay yourself back tax-free, penalty-free for any past medical bills if you have a copy of that medical bill. So this is a little convoluted one, and maybe refer back to an HSA episode I've done in the past, but this is a very unknown and a good source of backup type of money to have. I also think lines of credit are good to have open in case of backup plan needs. Then eventually you could go to 401k loans. Now the question is, are those good or not? I would highly recommend starting with those first ones that I've just went through. So that's all I have on backup plans. You need one. You need a couple. The second thing I've observed is you need to be diversified. In my previous episode in this series, I mentioned that the equity markets and the bond markets have both been down quite a bit this year. At certain points of the year, they've been down more than others. Currently, as I'm recording this, we're hitting our lows of the year. However, if you were to dissect certain parts of the market, and let's take the equity market, for example, the stock market, certain portions of this market have been down worse than others, actually a lot worse than others. The tech sector has been hurt. Some of the high growth tech companies have been hurt this year way worse than other parts of the market. And I've seen a lot of mid-career individuals and families been actually over allocated to this specific sector. Just because it's been in vogue and it's worked very well over the last 10 years. So this has been common. So if someone was over allocated to this tech sector this year, they could definitely see or have seen their portfolios down 40 to maybe even 50% this year. So that's a hard number to kind of come back from at any age. So what can we learn from this? I think you need to learn that mid-career, if you are this mid-career person or family, you need to earmark your accounts, earmark your funds, and you need to address your risk per those accounts. To keep it simple, let me talk about it this way. If you earmark your retirement funds, so like your 401k or your IRAs for long-term investments, which they should be, then they should be in a well-diversified, well-allocated portfolio that rebalances on a certain time frame to give you the best chance of success over a 20 to 30-year time frame. There's a lot of history and math and reports on the positive outcomes that this type of investing can do. Now, you can still be in all equities, but in this type of world, but you need to make sure you need to make sure that you're well diversified within those equities to protect yourself. Now, I love tech, and speaking of tech, I love tech, and I think you need to be in tech, but sometimes you might need to earmark certain accounts that maybe quote unquote are your fund money to be a little bit more over allocated into certain industries or sectors like this, for example. So all in all, you need to take things with a grain of salt in your investing. The third lesson learned and the third observation is you need to be opportunistic. This is more on the opposite end of the last two that I've just talked about. I've seen some mid-career people that actually are earning more income that they have over time right now, but they're scared. They're emotionally charged on this stock market and the news and the negative headlines going on that they don't want to invest right now. And it just blows my mind. This is like the best time that you can invest. And I'll talk about that in a minute. But what I hear, the observation is a lot of these people in this category will say, hey, I'll get back into investing and planning for my retirement when things get better, quote unquote, when things get better. And this is just in reality, the opposite of way of what you should be thinking. Okay, what can we learn from this observation? One thing to learn is that you should be happy because you have a long time frame until you retire, at least 20 years probably, in my thinking. If you're in your mid-40s, you have at least until you're 65-ish till you retire. Another good thing is that if you're continuing to contribute to your 401k and your IRAs on somewhat of a continued basis. So if you're 401k, you're doing that bi-weekly maybe. If you're doing your IRAs, maybe that's monthly. What you're doing is you're dollar cost averaging lower during these times when the markets are going down. So essentially, you're just reducing your overall cost of what you're investing in. And so when the market goes up potentially in the future, that just gives you more opportunity because you have more shares at a lower cost for the future. Another strategy that is more tactical is that when you see markets are down and down drastically like they are and have been this year, what you can do is you can fast forward your investing into when the markets are down. So let's say that you had a full year monthly investing plan into your 401k or IRAs, what have you, even 529s for kids, you're going to do $500 a month into each of them or whatever. Maybe if you have the actual cash around, you can kind of lump sum that into one payment into or one contribution into all of your investments and take advantage of the markets being down. This obviously requires you to have that cash on hand, but it's a good tactic to take advantage of downward trends in the market. Okay, overall, when we look at somebody or families that are mid-career, I've really noticed that, you have to have backup plans, and even take that further, that you need to have backups on backups. People have really been exposed this year with all of these 1-2 punches with inflation, possible layoffs on some people, just crazy things going on. You need to be diversified in your portfolio and your investing, even if you are mid-career. Make sure that you're kind of earmarking certain accounts and managing them correctly. And then you also need to be opportunistic. This is times, if you're in a good position, that you can really put yourself ahead in the future if you can play it well right now. So that's it for me today. Thanks for listening, and until next time, be well.
High Point Capital Group is located at 1200 North Mayfair Road, Suite 300, Milwaukee, Wisconsin 53226. Phone number 414-253-4600. Securities and investment advisory services offered through SagePoint Financial, Inc., member FINRA SIPC. SagePoint Financial is separately owned in other entities and/or marketing names. Products or services referenced here are independent of SagePoint Financial. Views expressed here should not be construed directly or indirectly as an offer to buy or sell any securities or services mentioned here. Investing is subject to risks, including loss of principal. Past performance is not a guarantee of future results. Indexes are unmanaged, and investors are not able to invest directly into any index. Sector investing may involve a greater degree of risk than investments with broader diversification. However, there is no guarantee that a diversified portfolio alone will outperform a non-diversified portfolio in any given market environment. No investment strategy, such as asset allocation, can guarantee a profit or protect against loss in periods of declining values. Please note that individual situations can vary. Therefore, information should only be relied upon and coordinated with individual professional advice. Ryan Hitchcock believes the information presented here is accurate and was obtained from sources that are believed to be reliable. However, Ryan does not guarantee the accuracy or completeness of any information, and such information may be subject to change without notice from Ryan. Statements expressed by guests on this podcast are the views of those guests only and not of Ryan Hitchcock. Statements contained in this podcast may be statements of future expectations and other forward-looking statements that are based on Ryan Hitchcock's or guests' current views and assumptions and involve known and or unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statements.